Last week, less than half the homes that went to auction in Australia's capital cities actually sold, 47.4%, the lowest clearance rate since April 2020. And we were all locked inside wiping down our groceries. Nearly a quarter of the scheduled auctions were withdrawn before auction day. And of the ones that did sell, almost half sold before the hammer, vendors taking the early offer rather than risking a public flop. Now, most people read this as bad news. I read this as a power shift. Let me show you why. I'm AJ, co-founder of Handle Properties. We negotiate property purchases every single week, about $10 million a month. So clearance rates aren't trivia for us. They're the dashboard that we price our offers on. Today, what the clearance rate actually measures, why it's collapsed, what history tells us happens next, and the exact negotiating playbook we're running for our clients right now. All sources below. Quick mechanics, because most commentaries skip this. An auction is the purest real-time price signal in property. Live buyers, live sellers, and one moment of truth. Now, the clearance rate is the percentage of auctioned homes that actually go up to be sold. Above 65 to 70% indicates a seller's market. Prices are usually rising. Below 50% means buyers have walked and vendors haven't accepted the new reality just yet. The gap between vendor expectations and a buyer's willingness is the negotiating opportunity that we have been waiting for. And this isn't one bad week. Clearance rates have been under 60% in 10 of the past 12 weeks. Auction volumes are shrinking too. Just 1,869 capital city homes went under the hammer, the fifth straight week below year-ago levels. Vendors are pulling listings rather than testing the market. Three forces have hit us all at once. One, rates. 3 hikes this year, cash rate at 4.35% as of May. Borrowing capacity has shrunk, whilst the RBA has warned inflation would stay higher for longer. Tax uncertainty. The May 12 budget dropped the biggest property tax shakeup in decades. Negative gearing restricted, 2 new builds, and CGT discount replaced with the new rules from July 2027, pending the legislation changes that are currently in motion. What happened? Well, buyers froze whilst their accountants did the maths. Prices already rolling over. Sydney fell 3.2%, Melbourne 2.6%, and that's just in the June quarter. Nobody wants to catch a falling knife at a public auction. Rates, tax, momentum, all pushing in the same direction. That's why this isn't a blip. But here's the part that matters if you're deciding whether to act or hide. The last time clearance rates were at this kind of record lows outside of COVID was a 2018 to 19 downturn, and before that, late 2022. Both times the pattern was identical. Clearance rates bottomed before prices bottomed, and both turned around well before the news cycle ever did. In 2022 to 23, national values fell 7.5%, bottoming in Jan 2023, and then they went on to rise 8.1% over 2023, whilst rates were still rising. The buyers who transacted at sub 50% clearance rates bought at the trough. The ones that waited for good headlines paid a recovery premium. And the structural floor has not moved in Australia. Vacancy rates are still under 2% in every capital. Rents are up 5.7% for the year. Renters are spending a record 33% of income on rent. And a forecast 262,000 homes are now in shortfall against the national targets. Weak clearance, tight rentals, and a broken supply equals a correction with a floor under it, not an absolute crash. Now for the forecast. So let me be falsifiable. If clearance stays below 50% for another quarter and vacancies rise about 2.5%, I'm wrong about the floor and I'll say so. Watch that video. But right now, the playbook we're actually running. 1, hunt down withdrawn or passed in listings. That's where you can get some serious discount. That 23.6% of withdrawn rate is the listings of motivated vendors who've gone and publicly failed. A property that's been passed in at an auction has vendors whose expectations just got replaced in front of a crowd. That's the first call on Monday morning, not Saturday's fresh listings. And number 2, use sold prior psychology. Almost half the sales are happening before the auction day. Vendors are scared of a public flop, which means a clean, unconditional-ish offer, short settlement, means before auction buys at a discounted rate, giving the sellers some certainty. Certainty is the currency in this market. And number 3, anchor with data, not cheek. A lowball, no logic offer often gets ignored in any market. Now, a lowball offer with comparable sales, days on market, and quarterly decline attached to it gets counted. We use totality data in the offer email. Agents can't argue with the number. They can't argue with the index. And number 4, know which market you're in. This is a Sydney, Melbourne playbook. Brisbane, Adelaide, and Perth are still going up at record highs. Walk in there with a 10% lowball and you'll probably get laughed out of the listing. Windows like this don't announce themselves. 47.4% is about as loud as the data ever gets. If you want a team that negotiates in this market every week, doing it for you with a capital growth guarantee standing behind the research, book a free call in the link. If you got value, subscribe. I make one of these whenever the data says something that the headlines miss. And comment, have you seen a past in auction near you lately? Tell me the suburb and I can get back to you.